Hi, it's Sean Haynes with Agri CFO and the Ag Center, kind of giving the weekly commentary. Before I jump into that on the commodity markets, just want to give some thoughts on kind of this globalization versus deglobalization thing we're all feeling right now, especially in the commodity markets, I think, and worldwide. Over the past 20, 30 years, 40 years, maybe in most of my lifetime, the world's getting more smaller, right? Getting more globalized, shifting labor to China versus the United States, sourcing wheat from other areas. And there's been lots of benefit to that over time. And I think what we're all feeling right now is this big demographic change where these populations aren't quite growing as much as they used to be, and that incomes are starting to kind of level off when you start taking everything into effect, right? Like labor in China used to be crazy cheap right for the U.S., but now because of logistics costs and aging populations in China, that labor cost has come up and getting pretty close to our, or maybe manufacturing comes back to us. And so all this globalization is kind of decoupling a little bit. It's even affecting our interest rates in these markets, right? So we've had $1 or $2 or $3 trillion worth of investment from China and Japan, for example, to come to the United States and seek higher rates, while their rates at home were 0%, right? Just to kind of keep their economies going, and now they're can't afford to keep their economies going anymore on the backs of their central banks. So they're decoupling, right? They're leaving the global marketplace and bringing those monies home, right, to lend out into their own markets at a higher rate of interest rates, right, which pushes ours up, decreases the supply of money. Same thing's going on with grains, right? You at one point in time, we domestically we really relied upon U.S. grain and the ability to export it places, and we kind of controlled that global market. But now you've got Ukraine and Russia and these other countries that have learned to produce exponentially more amount of product and ship it all over the world and globalize. And now with these conflicts, right, and these demographics changes, now you're seeing them say, hey, we need to hold some of those grains ourselves, right? For example, Ukraine can't ship that grain out, which means Russia now needs to hold more to feed itself, which decreases the amount of grain in India, who then in turn holds back all their rice exports, right? And that affects us here at home too. So you're seeing people shrink back. So I think just hopefully you guys look at these things, kind of think about them. I think it's really easy for us to think about the United States as this little small world and only affects ourselves, but we're part of this big global world. And all these things have been happening, and these far outreaching places are really affecting us here at home, as well as things that happen here affecting people on a far outreach basis as well. So with that being said, we're kind of jump into commodity markets this week. Beef markets stay kind of relatively flat this week, still in the 250 to 270 range for 4.5 weight cattle on the forward basis when you look at the LRP. Current cash market's higher than that, 305 to 315 for the same cattle. Holstein calves and these beef calves, though, on these past cash sales have moved up. So beef on dairy crosses, I'm hearing some reports 600 to 625 for these calves starting August 1st, which would be tomorrow. And then bull calves on the Holstein side move up another $50 as well, just because the cash markets on the forward basis have supported it. And you've also got some kind of declining corn that's come off recently too on the feed side. So cull cattle are off a little bit. I think cull cattle volumes have really come into the market quite a lot. They're still in the $82 per pound range. Just a lot of cattle coming off of these low milk prices, so I think that's going to keep a continued pressure there. And there's just really kind of right now a standoff between the packers and the feed yards right now to see who's going to push back and forth for profitability. The packers are just kind of crying and lamenting there's not much value to them in the marketplace with retail sales coming off a little bit. Feed yards still have some profit in the cattle, but aren't willing to give it up and price the cattle lower to get them to the processors. So that's why you're feeling the stalemate right now, and all that leading into the Memorial Day weekend, where usually you start seeing some buyers wake up right now trying to get ahead of that and buy some additional beef because it's a grilling season type of product. So we'll kind of see who wins out on that side. But shrinking cattle supply, staying small. It's just been the way it is. Globalization wise, I think it's making U.S. beef more expensive and more desirable out there too. We're interstitially fat, white fat marbled cattle. Most of the cattle around the rest of the world are grass-fed. They don't have the same quality, the same demand for them. It's really two different classes of beef. So we're really standing out in the world as far as that goes, and there's some demand. It's also pushing on the consumers, though, because I look at the prices on ground beef lately. It's the highest it's ever been. And I was looking at these charts. It's $5.30 per pound on average across the U.S. It's never been that high, so you kind of wonder how much pressure that's putting on U.S. consumers as far as buying. And that's not even looking at a steak, right? So, and then as if that wasn't enough, all these pressures back and forth for the beef side. We've got this alpha gal syndrome. They don't call it alpha guy because if it was alpha guy, they'd make you eat more red meat. But it's alpha gal, which is this tick bite that secretes a sugar into your bloodstream and makes you allergic to red meat. And they think if a few 100,000 people may potentially have this thing, and it takes years for it to go away, no cure. So we'll see if that becomes any major concern for folks in the long run. But these protein markets with the beef side, as like I said, as long as these cattle inventories stay small, you're going to have smaller cutouts as far as amount of meat going to market. The U.S. consumers got some pressure because of overall inflationary concerns, which kind of pushing back a little bit. You got some logistics issue now with shipping to get them to other points of interest, which adding cost to the cattle too. So you kind of wonder where that's going to push back. And then you've got some relieving pressure on the feed side. So I'm not quite sure how it's all going to go, but on the long run, it looks good for U.S. cattle producers. Not so great for U.S. consumers of beef. And it's also kind of carrying along the other protein sources as well, as far as chicken and pork, and kind of lifting up because they're substitute meats. So that's the continued strength in the California and U.S. beef markets. Let's get on to dairy, which seems to be looking a little bit brighter this week. Dairy market's looking up a little bit. We've had a really sharp fall off on butt inventories when they actually did the actual count versus the reported count, which I kind of always think is funny how those change, right? When you call somebody on the phone and say, hey, how much butter do you have? And we expect people to be honest. And then when you actually go out and physically walk it off, it magically changes. But that's a story for another time. Butter inventory's off a good 20% in some respects, which has really pushed the butter markets up to all-time highs as far as movement goes. Cheese inventory is also getting kind of staying flat, but prices getting better. Both of those things have been pushing up the class 3 and class 4 prices under the forward curve. Not going to get much relief for July price milk being paid in August. It's still going to be $15 for most folks, minus before your components. But August looks like it's jumping up to the $17.50 range so far, and then getting into the mid 18s and then high 18s by November, maybe crossing $19 here pretty soon, which most guys with feed costs coming off should be able to make a profit at. So Holstein beef calves look like they're gonna be $275 to $325 here pretty quick, move up about $50. Consequently, these beef on dairy cross calves, I'm hearing some rumors, and they'll be $625 beginning August 1st because the cash sales have been so strong on the backside, and the demand is just really high for these cattle, and everybody's looking at the forward curve for the amount of cattle becoming available, and it's really shrinking up quite a bit and staying small. Feed costs have come off for most of the dairies. We're seeing hulls in the 115, the 120 range for new crop. Average price for dry cow alfalfa is $230, another $40-50 on top of that for milk cow hay, much lower than last year. And then straw, you just can't seem to give this stuff away. It's $50, in some cases wheat straw $70-90 if you can get it sold. But all of that points to kind of a resetting feed cost come September. Yields look like they're pretty good on most of the corn crops I've been driving around taking a look at, so we should see some good quality, some good yields coming off for silage this year. Water hasn't been an issue, and some guys in some areas have actually planted ahead of that, so feed costs in that range have come off about $20-30 per ton as well. So we should get some relief on the feed side last quarter this year with milk prices coming up on top of that, and then I think these calf prices are going to stay high as well, maybe cull prices staying good as well. It's dropped off a little bit. It's down to the 82 cents to $1 per pound side for good yield in dairy cattle. But if we can kind of hold on to that point in time, you should get some relief, which is good to see. Globalization wise, just, European markets had built up a lot of cheese inventories. That's sort of going away. And I think some of these logistic issues that folks are seeing are kind of pushing these prices up a little bit for U.S. markets, even though we're at parity with the world, because the shipping costs to get goods and services here and to other places have gotten more expensive for them, especially look at Russia, for example. You can't even get stuff to the country. So we'll have to see where that all ends up. But in the long and short of things, dairy looks to be looking up in the next 60 to 90 days. Guys have had a really hard slug about it and have really had to tighten their belts quite a bit, and it looks like that may be ending pretty soon as long as guys are producing well and moving into these cheaper feed prices. Last but not least, I want to talk about on the dairy side, going forward basis, I think we may have a longer recovery that's going to last a longer period of time when it finally does, because I'm looking at these heifer numbers, and the availability of replacement heifers in the U.S. have really come off quite a bit. The amount of heifers calving per 1,000 dairy cows in the United States at the all-time low, probably 20-year low. Guys have really been crossing out to beef a lot for a long time, really slimming down the amount of heifers they actually carry. And there seems to be a little bit of a hole coming up this year, and maybe like 160,000 to 200,000 head less heifers calving this year than the prior year, and it's been slinking down every year for the past 5. So, and that's not something you recover out of really quickly, right? Once you ramp up heifer production, it takes another 2 years for that calf to hit the barn and be milking again. So if we can kind of get a correction in these cattle numbers and some other parameters moving up like we talked about, and we have this heifer hole coming up next year, may signal a good period of milk prices next year. So we'll have more to talk about there. So that's the brightening picture for dairy here in California. Let's get on to California crops. Growing conditions tend to be pretty good still. We've had a lot of heat in the past couple weeks, but we actually kind of needed that to get things jump started, get some sizing up, get the tomatoes ripening. Tomato crop looks really good in the prairies of state that I'm driving up and down. A little bit late, which kind of concerns me as far as processing goes, and hopefully they don't hit all the process at the same time and or get rain on them before we can get them into the process and lose our insurance coverage. Hay off still, $230 average milk cow hay, 275 average for dry cow hay. Forage hay still in the 120 bottom end to $170 market. Can't give straw away. It's $50 for rice straw, $79 for wheat straw if you can sell it. Almond hulls have come off quite a bit as well. As those processors are trying to get cash flow back in. So that's 115 to 120 delivered in most cases. I even saw one load go out at 105 last week, which was kind of surprising. I'm not sure what the quality was, but it is what it is. On the backside too, fresh crops, stone fruits doing really well. So peaches, nectarines, cherries, what have you, have been flying off the box. Peaches still in there, $29 to $31 range, is pretty flat. Watermelons picked up a little bit. They're $183 to $217 per 24-inch bin, depending how many watermelons are in that bin. But that market's continued to strengthen, especially coming in the Memorial Day season. That's usually what we see there. Nectarines flat, plums kind of flat in that $27 to $39 range, and cantaloupes $8 to $10 per carton. So far, growing conditions good. Quality's been good. Haven't heard a lot of issues with logistics either, getting things shipped around. So produce markets seem to be pretty strong this year, at least steady. Strawberries up a little bit, $14 for conventional, $19 for organic. They're kind of heading toward the end of the season here, last quarter. We should see more and more strawberries coming in from other states like up north in Washington and then south in Mexico as we get late in the season. But we're still off about 15% from volume from last year, so we'll have to see where things go from there. But all in all, crop seasons look to be pretty good. Water seems to be plentiful. Haven't heard about a lot of stress in anybody so far. And then in the next probably 4 to 6 weeks, we should be able to get you some initial reports on what tomato processing tomato tonnages have been coming out of the field and what the quality, if anything, issue-wise has come up from there. So California crops continue to progress well. Prices seem to be holding. Let's get into rates. Bond markets and interest rates kind of up across the board. Short-term stuff, 30-day money, not really moving a whole lot. But anything out past that, 1 year, 2 year, 3 years, up about anywhere from 0.10 to 0.15% on the bond market. I don't know if that's kind of digesting some of this increase that was done this past week, or they're kind of preemptively increasing rates and demand for this rate increase that everybody's talking about September if we don't continue to see a fall off in these inflation rates. Although the other thing that could be happening too is there's a threat or a movement coming from Asia where China's already pulled money back out of our markets to kind of bring money back home. And then Japan's going to do the same thing. Japan for at least 10 years, maybe even 20 years, has been using their central bank to buy assets. So any 10-year bonds that hit the market, they buy them at 0%, right? They just go buy that bond. They're the market leader and the market maker for bonds. So they've kept interest rates low to keep their industry afloat. I think they're at the point now where they own between 7 and 10% of total stock market. They've even done that much. So they're really propping up the entire economy in Japan for a long time with their central bank. And at some point in time, you run out of the ability to buy things, or otherwise the central bank owns everything. And so now what they're talking about doing is changing things, bringing back money that they were using in U.S. treasuries, right? And enticing that money back from Japan by raising rates at home. And so if they raise those rates at home and the money moves out of U.S. markets, which could be the tune of anywhere from $1 to $3 trillion, it's going to put additional pressure on the U.S. markets to raise rates to keep the money here or entice money from someplace else to replace it with, right? So that price of money has been changing worldwide, and it's going to pull away from us if it does. And if that happens, it kind of pushes rates up on all of us as well. So we'll have to see where that all goes. Home mortgage rates, they've been up in the 7.3 range for a 30-year money, 6.81% for a 10-year money. Those are up again, almost another quarter point, kind of response to the rates last week and some forward-looking rates in September pushing up as well. Jumbos followed the same thing. They're sitting in the 6.3 to 6.4 range. So we'll see how that goes. It still hasn't affected the housing market too much, right? Because that tight supply, but the affordability index is pointing downward. I think it's down like 20%, the amount of people that used to be able to buy a house. It used to be 65% of folks that were working could buy a house. First-time home buyers would qualify. Now it's down in the 50s range, especially here in California. It's even tighter than that. So it's trending in the opposite direction. And what I'm worried about is that you've got, inflation and these higher interest rates destroying demand by taking people's ability to buy the homes away from them. You've also got the same thing happening on the ag side where ag rates are at 7.75%. On the floating money, as high as 8.3%, and all those have run up across the board about 0.15 to 0.2% this week in response to this rate increase. Again, commodity prices kind of being flat except for a few key commodities, and rates being higher, it's really put a constriction on how much ground's been trading. I'm really wondering what's going to happen after this crop cycle. This 300 because these crops off. Caesar finally returns on these nuts, walnuts, and other things, and after he makes the decision to sell. And dairy is another prime example of that as well. So there may be some forced sales or some pressure to get some liquidity back on these operations, and folks are going to look to unload real estate to do that. And because these higher rates and these low commodity prices, I really wonder what those properties are going to hit the market at. So we'll have to see if it actually has an economic value or if it's got some kind of imputed value based upon a future event that we don't know about, right? So I kind of look at these things that don't make sense to me. But I'm just an economist, and I'm kind of simple that way. So that's what's going on in the always interesting interest rate markets. Let's get into nuts here in California. Almonds continue to slide off on kind of weak demand and this coming large crop that everybody's anticipating that came out to the objective estimate. Not off a ton, but off a good, 2 cents to 10 cents across the board. It had a little bit of recovery in the Butte, Fritz, and Carmel Monterey meats, but still low prices. And for most folks, it's going to be a little bit below or profitability or at that break-even point, depending on what your production is. We'll have to see if that objective estimate was correct or not as we get into the harvest season. These next 30 days, the weather risk is pretty much gone from these trees. We're kind of finishing the nut up. As long as they get watered, they're going to finish out. So we should start harvesting and start getting some information back on that. Walnut side, starting to do some pre-sales on this year's crop. They're moving up a little bit, but not near enough. They've up, depending on who you're talking to, between 10 cents to 15 cents per pound over last year, which is a good move, but only about a third of what it really needs to be to get to the point where guys can actually break even to make money on these things. So you wonder when they're going to start pulling these trees out. And it's a global issue too, right? So I think the things I'm watching for is, alternative crops in California, which is large producers, nuts, does that force guys or incentivize guys to pull out? And then watching China, which is really hard, but China produces 2.5 times what we produce now. They've really taken kind of the global walnut market by storm over the past couple of decades, but you also have some competing issues over there as well, right? But they've got irrigation problems. They've had same kind of drought issues we've had, and they've got this population that really needs grains, and there's been a constricting supply of grains, especially in rice, right? If you look at the production of rice last year, they kind of got wiped out with that late season heat wave they had, and the inability to get irrigation water to those paddies that really decreased their rice inventory levels. And now you've got India holding back their exports of rice, which is 40% of the world market again, and China being a leading consumer of that rice. It makes you wonder if they're going to maybe make some key decisions to pull some ground out and start converting things over into rice paddies and things like that, which, I don't know, could include walnuts, given the price and the ability to make those things widely available to their populace. So we'll have to see what happens there, but something to watch over time. And the pistachios, I don't have a lot of information on those right now. Price to continue to stay, in the mid $2 per pound range. Production estimates for this year look pretty good. Everybody says the crop sits really nice. And so we'll have to see where that all comes in. But demand stays hot for the pistachio market. You see, I think more and more people looking at putting those trees in as a replacement for trees coming out, especially because of their ability to handle less water in bad drought years. So, as always, thanks again for kind of listening to my ramblings about the California commodity markets and what my thoughts are and what's going on here. If you have a commodity we aren't talking about and you want us to, let us know. We're going to be adding some vineyards information here pretty soon for the wine markets on the north and central coasts, as well as the Central Valley here, to kind of round out our offering. But we always like to hear feedback, and hopefully you guys find it useful, and click those likes and shares and what have you, other buttons they put on the different platforms, so we can kind of keep getting this information out there in a broad audience. And I appreciate you guys' patience and time. Thanks.